Welcome back, everyone. Today on the Joseph Carlson Show, this is a sell American trade, according to the analysts. It's time to panic and sell off the best American companies, which is exactly what the market is doing. If we look at the S&P 500, the companies that are selling off the worst are the biggest tech leaders in the United States. And of course, this sell-off is happening because of, well, the usual suspect. President Trump has rhetoric that the rest of the world does not like. He's continually talking about Greenland and how he has plans for America to run and operate Greenland. And of course, this has caused a lot of panic in the markets, a lot of turmoil, a lot of people very upset at Trump, different world leaders posturing against him, causing what could be another big trade war and many people to avoid American stocks. Well, of course, the answer to this is not to sell America. It is to buy America like it's always been. We'll be going over this entire story and how I'm positioning my portfolio as a response. And we also have a ton of other news to get to today. For example, it's Netflix's earnings report. We're going to be looking at that. We have Duolingo, a company that's down nearly 70%, my biggest loser in my portfolio by far, and I just bought more of it, another $5,000. We'll be going over that buy. We have news that Chris Hohn, the legend himself, has once again destroyed the S&P 500 by only owning a handful of stocks. He's made more money than any hedge fund manager in history in a single year, shattering the record with $18.9 billion in gains in 2025. We'll be looking at what is causing this incredible outperformance from Chris Hohn. And then finally, we have the fail of the week, which in this case is a clip from Mr. Beast Games where a contestant took $1 million to eliminate a bunch of other contestants on his team, causing betrayal and lack of trust, but making him also have $1 million. We'll be looking at why this is the fail of the week at the end of this episode. So this is going to be a busy one. We have a ton to get to in this episode, and we start things off with the headline news, which is the fact that the markets are tanking today, especially the equity markets within the United States, and especially tilting towards the biggest companies. So you see it across the board, the Dow Jones, the S&P 500 are selling off, but the NASDAQ's selling off the most, over 1.5% on the day. The big companies like Nvidia are down more than 2%, in many cases 3%. Companies like Amazon are selling off big time. And this is again because of this trade. This is sell America. The US dollar, sell it. You have treasury prices tumble and gold spiking. And we have different analysts like this one from the Global Policy and Central Banking Strategy at Evercore ISI saying this is sell America again with a much broader global risk off. Now, why is this becoming a trade? Why are people and analysts like the ones from Evercore ISI saying that this is a sell America trade? You may have heard President Trump talking about Greenland and his ambitions with it for some time. Here's the latest from just today.
Look, we have to have it. They have to have this done. They can protect it. Denmark, they're wonderful people. And I know the leaders, they're very good people, but they don't even go there. And, because the boat went there 500 years ago and then left, that doesn't give you title to property. NATO's been warning Denmark for about 20 years now, longer than that, 25 years. They've been warning Denmark about the Russian threat. And it's not only Russia, it's also China. So we'll see what happens. But let's put it this way. It's going to be a very interesting Davos.
That was Trump's introduction to Davos, talking about one of the most contested, polarizing things he could, which is his ambitions with Greenland. This followed escalating tensions over the territory, with Trump having launched a series of tariff threats in an effort to pressure Europe to drop its opposition to the U.S. takeover. The subject is taking center stage at this week's gathering of political and business leaders in Davos, Switzerland. Now, we know that Trump likes to make discussions about himself or at least things that he's interested in, and he's accomplished that again. We have all these amazing business leaders going to Davos. They're going to be discussing their companies, artificial intelligence, technology, all the different things that they're doing. And Trump, of course, wants to talk about the subject he wants to talk about, which is Greenland, which is tariffs, which is the U.S.'s ambitions there. And he's made this the center stage by continuing to build up this rhetoric leading into this big meeting. So, of course, the markets are looking at this and they're deeply concerned about another tariff war, about another trade dispute, about tensions rising and partnerships being broken. Greenland has repeatedly rejected Trump's request to purchase the Arctic island, with Prime Minister Jensen Frederick Nelson saying Monday that it would not be pressured and, quote, stand firm on dialogue, on respect, and on international law. European officials have reportedly considered using the salvo of counter tariffs and other punitive economic measures against the U.S. in retaliation. European officials are coming up with ways to hit back at Trump because they know that his favorite tool is tariffs. This Sell America trade suggests that global investors will place higher risk premiums on the U.S. investments amid fears that the U.S. is no longer a reliable trading partner. Following Trump's latest threats, some investors worry that European countries could dump U.S. assets in a show of power. Ray Dalio also agrees with this, reiterating the point that right now, U.S. allies are looking to dump U.S. assets and looking for different trading partners. He's in Davos talking about this very issue and this global change.
Even allies do not want to hold each other's debt. They prefer to go to a hard currency. This is logical, and it's factual, and it's repeated throughout history.
So Ray Dalio believes that allies of the United States will be less inclined to buy U.S. assets in debt and more inclined to buy gold. He continues to be very bullish on gold. With an inflamed situation between the United States and trading partners, the way that this is being framed in many cases is that this is going to cause a capital war. Different countries using different economic measures to fight between each other to try to gain leverage. And this is the message that Ray Dalio is sharing and also scaring a lot of people with today.
So let's just look at the fact that on the other side of trade deficits and trade wars, there are capital and capital wars.
Now, it feels like everything he's saying is true. All of it seems accurate here, but it is the same thing that he has been saying for some time. For example, Ray Dalio back in 2019 had a post on LinkedIn called The Paradigm Shift, which is almost the exact same thing he's been saying just today. It's only rephrased in a few different ways. But Ray Dalio has been outlining this new global order change for at least 6 or 7 years now. So what are the effects of this? Well, there's both short-term and long-term effects of this global escalation, these trade tensions that are impacting the markets today and will in the future. In my portfolio, the effects right now are that the portfolio is going down. If I look at it on the one day, it's down 1.1%. We have MasterCard, which is down over 1%. S&P Global's down 2%. Moody's down the same. Intuit down 1.5%. Equifax down 2.3%. So all the global monopolistic companies, these duopolies, these ones that work on credit rating, investors are pricing in that there's going to be a fleeing of U.S. assets. There's going to be less deals going forth. That's bad for the markets. That's being immediately priced in today. We have big tech holdings, ones like Google. This one's down 1% today. We have one from the Netherlands, which is one of my favorite companies, ASML, which is down 1% today with the rest of the market. We have Microsoft down 1%. We have Salesforce down just a bit. The only holdings in my portfolio that are in the green on the day are the atypical ones, which is Costco here. This one's up 0.5%. And we have Texas Roadhouse, which is up almost 1% today. Texas Roadhouse has been on a tear recently. Then we look at the Story Fund, my secondary portfolio. This one's down a bit today as well. If we look at the one day, it's down 1%. We have Amazon being the biggest loser, down 2.23%. Netflix is actually in the green today going into earnings. These three are positions that I have in both portfolios. And then we have Duolingo, which is actually in the green today by 0.5%. So overall, a decent hit to the portfolio, but this isn't any huge sell-off by any means. It's nothing to panic for. When I look at the situation today and I read the news, I read the frustrations with trade, I read the threats and the tariffs and the disruptions. I read Ray Dalio once again talking about a new world order and how everything's different, like he has for the past 7 years. I come to the same belief that if the rest of the market is selling America, I'm going to be buying America. I'll be buying it every single time. Nothing has changed in my viewpoint of America being the place where alpha is going to be generated. I've said since the beginning of my channel back in 2019 that America is the place to invest. It is the best country to invest in by far. I don't even think it's roughly close to anyone. I don't think there's any close seconds if I'm being honest here. There's a lot of great companies in Europe. Europe has Spotify, they have ASML. There's great companies in Canada. There's ones like Brookfield, there's ones like Shopify, and many others. But for every great company there is in a different country, there's like 10 to 15 to choose from in the United States. 10 to 15 that are going to generate excess returns and greater earnings despite what the trade wars do. You can look at Amazon, and this is a company that's down big today because of trade fairs, because tariffs, because higher prices. But that was the same concern that we had in April of 2025. Remember the big tariff sell-off? Remember what people thought at the time? People thought that trade was dead, that relationships were completely severed, that it was the end of American exceptionalism. I heard people honestly tell me in April of 2025 that this time it's different, that American exceptionalism is done. Why would you want to invest in America when they're clearly breaking all these relationships, when they're clearly isolating from the rest of the world and when clearly American exceptionalism is on the demise. Things got so bad in April of 2025 that great investors, many of them that are exceptional investors, great stock pickers, they can do fundamental analysis, they begin to abandon their own thesis. They looked at the prices of stocks dropping. They thought that they're not good at picking stocks because they're going down now. They're concerned about the world order, how things are going to work out in the future. Everything felt really bad during that time period. But ironically, as per usual, looking back, that time of chaos, that time of doubt was the absolute best time to invest. The investors that bought America during the very time where you were supposed to be scared of America, focused on its inevitable demise, was the exact time where investors earned the best risk-adjusted returns in the future. And the investors that stayed level-headed, that kept their holdings, that stuck to the plan, even though they didn't know exactly how things would turn out, but they stuck to great companies, were rewarded handsomely in the end. We saw many investors do that with Amazon, with Google, with ASML, using all these concerns in the past as a time to buy. When I see headlines like this is sell America time. This is literally analysts telling you this is the trade now. I think these are the type of headlines that you are warned about specifically to avoid when you start investing. When you started investing, you're probably warned, you gotta ignore the news. You gotta ignore the daily volatility. You gotta look at your companies, their earnings results, their operating income, their business models, their products, and ignore the troubling, fearful news that comes your way. This is the news that they're talking about. The best investors in the world are not going to be concerned about this news. The ones that stick to the plan, the ones that generate alpha, Warren Buffett is not going to be concerned about this news. Now, Warren Buffett's getting old and he's not doing interviews as frequently as he once was, but I have to believe that if he was being interviewed today, one of the things he would say is that he still is buying America, that America is still exceptional, that this is a great place to invest, and that he doesn't know what's going to happen over the next 2 to 3 years, but he knows that in 10 years, the stocks he owns and the companies that he owns are going to be a lot more profitable, that the S&P 500 will be a lot higher. That's a message that he shared during the most bleak times in 2009. He shared to invest in America, which looks far worse than anything that we're facing right now. We also have investors that you can imagine, any of them, Chris Hohn. We have investors like Dev Kantesaria. You think that they're panicking and selling their holdings because of this? I find it very doubtful. Most of them get their excess return by being concentrated in the best assets and not letting inherently short-term news dictate their actions. And don't be mistaken, tariffs are short-term news. Threats and trade disputes are short-term news. This type of stuff can go on for a couple of years, but if you even look at Trump, and you can say what you want about Trump, you can feel however you want about President Trump. You can believe that he's a very powerful negotiator that stands by his negotiations. He doesn't take no for an answer. He finally stands up to different people, and you can view him in that light, or you can view him as a bully that's threatening different trade relationships and making so allies are upset at us. Whatever way you view him doesn't matter. It doesn't matter to Amazon in the next 20 years. It doesn't matter to Microsoft in the next 15 years. It's not going to matter to NVIDIA. None of this will play a crucial role in the outcome of these companies over the next 15 years. So right now, this is just a blip in the radar. We have a down day of 1.5%, but this again could evolve to a big sell-off. We could see another big trade dispute and escalating rhetoric unfold. And we could see the markets react like they usually do, pricing in all of this type of data. When I look at it, I react the same way that I always have in these type of situations, or if the market wants to give me an entry point on some of the best companies in the world, I'm going to use it. I'll happily look at companies that I own trading down because of this type of news, and I'll look for different positions to add to. I would love to add to the positions I'm already bullish on. I've already added so much money to MasterCard. I'm so bullish on this company. Google's getting better by the day. The products that they're releasing are exceptional. What they've done implementing Gemini into Gmail is incredibly powerful, and they're doing the same thing with all different aspects, making it a true personal assistant that helps you in different ways. One of the big ones that's hit today is Amazon. This one I already believe is underpriced, but because Amazon is one of the primary victims of any type of tariff or trade dispute, it's looked at as one of the companies to sell off, which I believe is a mistake overall. People are still going to buy from Amazon. Amazon offers too much convenience to consumers to switch to an alternative. So this is another company that I'll be looking at increasing my position if this bleeds into a larger sell-off. As of today, the company that I bought $5,000 more of, I just bought it this morning, is Duolingo. This is one of the few companies in the red in my portfolio. It's currently, with the $5,000 buy today, a $20,000 position with $15,000 in the red. So it's down roughly 50 to 60% from where I initially bought it. And anytime a company sells off like this, I take it seriously and I look at the reasons the company's selling off and try to understand what the market doesn't like about the situation. And there are things that clearly Wall Street and investors are concerned about with Duolingo. The biggest one is the decelerating growth. If you consider the situation of Duolingo, Wall Street expected them to have 27% booking growth, which is the amount of subscriptions they have that they booked ahead of time because people pay a year in advance. So Wall Street expected them to have estimates of 27% booking growth. Duolingo reported 22% growth. So 5 percentage points down below Wall Street's estimates. Now, any company that comes in below estimates of their future growth has a sell-off. It's a resetting of expectations. Wall Street expected them to be up here at 27. They came in here at 22. That means that the stock needs to re-rate. But the stock sold down around 25% after those last earnings just because of 5% lower bookings expectations. That's a very severe reaction for Duolingo. It shows that Wall Street is punishing this company harshly for any slight miss in their expectations. Wall Street is re-rating the stock. They're putting it from a premier category of a fast-growing company down to now just a moderate grower, a company that's expected to grow slowly over the next 5 years. And I asked the question, is the sell-off in this stock justified? Is Duolingo really today worth 60% less than the company it was 6 months ago? And I continually believe that that answer is no. I think that Duolingo has reason to sell off. I think that the stock should be down, but I don't believe that the stock should be down 60%. And the fact that it continues to trade down like it has, I believe is a bit of an over-punishment. But this behavior with Duolingo is nothing unusual. Stocks routinely trade outside of their fair value range. There's a lot of different ways to value Duolingo based on their booking growth, based on their operating margins, and what you believe will happen in the future. But what I know right now is looking at Qualtrim and looking at these charts, I can clearly see that Duolingo is still in great shape. This is the revenue growth, growing 40% as of last quarter. We have subscription revenue growing 46%. We have the daily active users growing 35%. In the last quarter, they just announced the preemptive quarter that grew by another 2 million. So even during these AI concerns, during all this disruptive technology from artificial intelligence, Duolingo's adding on millions of incremental users every 3 months. EBITDA is trending upwards over 100% year over year. We have free cash flow trending up 55% year over year. Even the free cash flow per share, which factors in dilution, is up nearly 50% year over year. So you can argue over the valuation or the exact best time to buy the stock, but from what I can see, it's difficult to argue that Duolingo isn't headed in the right direction fundamentally. Every fundamental, every KPI points to a company that is growing, and it's growing quickly, faster than most companies in the market. Until that changes, I'll continue to hold the company and buy more of it when the stock is selling off. Now, moving on, we also get to news today that we have Netflix reporting earnings after market close on the day. Now, usually this is a big event. Netflix is one of the first big tech companies to report earnings, bringing in the earnings season, which we'll be going over and reviewing all the companies soon that are going to report earnings in the future. And Netflix, again, is usually one of the big ones. It's exciting that everybody's focused on. And it is true, Netflix's earnings report is important. Investors will be paying attention to it, and Netflix will likely do great. When we look at the numbers, Netflix is a company that people may have forgotten amidst all the other news with the acquisition, but Netflix is a company that's actually really good. It's growing quickly. The revenue grew 17% year over year last quarter. We have revenue growing across every region. We have the total subscriber count that's not factored in anymore, but it left off at 301 million, and they may give a big landmark update on that. We don't know how many subscribers they have because they haven't given us any large updates on it, and I doubt they will during this transaction phase, but we know that they're growing in the amount of subscribers. We have the content budget, which has remained mostly flat while the rest of the company has continued to grow, meaning their expenses are flat, their revenue's growing, creating enormous operating leverage and margin expansion. That's why we're getting this enormous growth in free cash flow. You don't see this type of operating leverage unless you can keep costs flat. So that's what Netflix is doing. All these metrics look incredible. Netflix is an incredibly powerful company. That's why I invested in it. But a lot of this is being overshadowed, of course, by the big news. So even though investors are excited about Netflix's earnings report, it doesn't feel quite as exciting as it normally is. It doesn't feel quite as meaningful as it normally is. And that is because everybody is really focused on the big picture here, which is Netflix buying Warner Bros. This earnings report doesn't matter quite as much when you have this large of a transaction that's still in pending mode. We don't quite know whether or not this will really go through. Now, Netflix is taking actions to further solidify this deal, and they're doing so by changing it from part cash and part equity to all cash. Now, this new all cash transaction continues to be valued at $27.75 per Warner Brothers Discovery share. And they continue to leave out Discovery Global, which means that they can sell that business off separately. The reasons that they highlight they're doing this, they say the all cash transaction provides enhanced certainty around the Warner Brothers Discovery stockholder that they'll receive at closing. So it simplifies the deal. It makes it less reliant on Netflix's stock. This will eliminate market-based variability. They also say that this will make it much quicker because this is a more simple deal to get done. The revised transaction structure is expected to enable Warner Brothers Discovery stockholders to vote on the proposed transaction by April 2026. To support this accelerated timeline, Warner Brothers Discovery has today filed its preliminary proxy statement with the SEC. So they say by April of this year, meaning that we're probably going to have a vote on this thing in March. So while I'm excited for the Netflix report, I just don't think this one is that meaningful. It doesn't matter that much. There's too much riding on this big deal. It's too much of an overshadow to what's going on here. I think the most enlightening thing that we'll get out of this earnings report is probably the Q&A section when they're asked about the Warner Brothers Discovery deal. I think we'll get a little bit more insight into their thought process, and hopefully questions from the analysts create more clarity. Now, next we get to this Davos interview with Andy Jassy. This is just from today, and he's talking about the impact of AI on jobs. Specifically, is it going to create more jobs or is it going to remove jobs? Now, of course, Andy Jassy is very careful with how he answers it. But in a roundabout way, he says a lot of the things that we do are going to be replaced by AI and better efficiencies.
I think what I said was I've in the next few years, I could see or having fewer people than we had before. Some of that, a lot of that will be just our continuing to allow ourselves to move quickly, as it's important culturally and speed-wise. But I do think that jobs are going to be impacted by what's happening with AI over time. They're not in a significant way yet, but I think you'll see that if you just think about how AI and agents will enable you to do coding and customer service and research and analytics. Even just the idea of doing spreadsheets the way we've done them in the past, I think those will be pretty different. And so I don't think that wipes out all those jobs. But I think we'll still have plenty of people in those roles, and those people will start their jobs, each task they pursue at a higher, more advanced starting point. All the rote work that we used to all have to do before we could get to actually the thinking work, a lot of that will be done by AI. So we'll still have people who will be able to invent quicker and more easily. But I do think that you won't need as many people in all those jobs that we've thrown humans at for the last 20 years. That said, I do believe we're hiring a lot of people now in AI and automation and robotics and our low Earth orbit satellite that we're building in healthcare. So we're going to have a lot of people in other businesses we're pursuing, and they're going to be brand new jobs that we haven't thought of. I mean, 15 years ago, there weren't jobs like cloud architect. Right. Those didn't exist. And whenever you go through any big technology transformation, you find new jobs. I think the same is going to be true here, medium to long term.
This is, of course, the exact right answer. Everyone knows and can envision the different types of jobs that AI will disrupt, the ones that it can do easily. What's more difficult to envision is that whenever you disrupt jobs by making companies far more efficient, the companies make far more money. That money is then freely reinvested into different businesses, which is exactly like Amazon has always done. They build one business, they make it profitable, and they use the excess profits of that business to create a new business. Amazon's always building, refining, making it profitable, and then using the profits to reinvest attractively into something else. And AI will speed up that process. It will make them more inventive. It'll make it so that it can create new things quicker, which means that you have more businesses You have better profits. Now, next we have Joel Kaplan from Meta talking once again about Meta's ambitions in superintelligence. Here's what he had to say about it.
I mean, the first thing is what we're trying to build. Our ambition is to build personal superintelligence, which means putting superintelligence in the hands of everyone. We've got a platform that serves 3.5 billion people every day, so we have some real advantages there. And we are spending a lot of money to build the massive data center and power infrastructure necessary to bring that vision to fruition. And we're confident that with the right models and the right products, we're going to be able to build personal superintelligence and empower everyone.
So Meta's building personal superintelligence. Now, Google's doing a version of that with Gemini, where they're using all of the different assets that Google has, all the data they have over you, to make a highly intelligent, personalized assistant. Then, of course, we have Apple, which that's their whole selling point. You have the iPhone, and they want to create a personalized assistant that can work with you, use all the data on the iPhone to help you better. Seems like all the big tech companies are racing towards this same goal of personalized superintelligence. But in reality, if they fall short of this goal, if it doesn't come to fruition, then they're just going to repurpose this server capacity, all this computational power, towards making their ads run a bit more efficiently, towards making their AI tools for their users a bit better, to making it so that they can just use it towards their own demand. And they already have massive demand for server capacity for computation power. So in Meta's case, the best case scenario is they do accomplish the personalized superintelligence. But in the worst case scenario, it's still not bad. They're just going to repurpose all that computational power to making their advertisements, their AI generated tools, a little better. Now, moving on, I wanted to highlight this story. I thought it's another incredible example of this investor, Chris Hohn with TCI. He's in a league of his own. He really is. He's right up there with the best of the best. And his performance shows it. He made $18.9 billion last year. Not million, billion dollars in 2025. Now, if we look at the actual performance here, the total number doesn't even do it justice, because we have here that the British investor, TCI Fund Management, made $18.9 billion for clients last year, making it the most profitable hedge fund firm in 2025. That is according to a new estimate from Swiss investment firm, and which compiles the annual list of the world's top money managers based on their gains after fees in dollar terms. So this $18.9 billion is after fees are accounted for. Hey, investors, this is just money that I've made for you. I've made for you by selecting the right companies. TCI's haul was the biggest annual dollar gain made by a hedge fund firm in Edmund de Rothschild's records. The report said, topping the previous $16 billion record by Citadel in 2022. So Chris Hohn's even beat out Citadel. That's how big TCI is. And a lot of this is from deposits. It's from people contributing money and investing in his firm, but a lot of it is from gains. An enormous amount of capital that he now manages is from his own gains. It also trounces the reported $15 billion bounty that John Paulson scored in 2007, wagering against the housing market. So these aren't adjusted for inflation, but I think even if you did, he's still winning. I think even if you adjusted for inflation, he would still be winning. Now, how did he make these gains? Well, it highlights his strategy here. We've gone over it a few times. But for TCI, big, long-standing bets on aerospace companies paid off handsomely. The London-based firm had large stakes in U.S. jet engine maker GE Aerospace. That was his best performing one. He also has a few holdings in European companies or foreign companies that aren't recorded in Dataroma and different 13F filings. For example, the French aerospace supplier Safran and European playmaker Airbus are two of his positions, according to people familiar with the firm's positioning and regulatory disclosures. All three rallied last year as investors bet on stocks expected to benefit from rising military spending. Now, TCI finished the year with 27.8% gains in its master fund, according to people familiar with the returns, which crushed both the indices. He's beating out the QQQ. He's beating out the S&P 500. He's beating out the Dow Jones. There's no real benchmark that Chris Hohn isn't crushing. He's just doing an excellent job. I've never seen a hedge fund like this. What has led to Chris Hohn's incredible success here? There's a couple things that we can outline. First of all, one of them is that he's avoided the AI hype. So he's actively avoiding the hottest AI stocks. You don't see him investing in the biggest ones like NVIDIA, like Palantir. He's not buying those companies. He's avoiding them. while crushing the overall index and most investors that are headed into those companies. He also has a very concentrated portfolio. You don't get these type of excessive returns. You don't get this type of market-beating performance if you don't have concentration. If you're too broadly diversified, you'll more closely follow the market. The more concentrated you are, the more that your performance can deviate either high or low from the market indice. That's why concentration in many cases is looked at as risk. It increases your chances of underperformance. But when you're Chris Hohn and you select great companies that have incredible growth paths, that have very deep monopolistic market structures, it's very difficult for those companies to underperform in the long term. And then finally, the big thing that I notice here in his outperformance is he holds companies for a long period of time. He really holds these companies for multiple years. He lets the story play out. So it's incredible once again to see Chris Hohn top the list, the most profitable hedge fund, the one that's making investors the most money, crushing the markets. It's really incredible performance. Now, finally, we get to the fail of the week, which in this case is a 20-second clip from Beast Games. This is the TV series that Mr. Beast started. I think it's on Amazon Prime. And this is one of the episodes. Now, admittedly, I've not watched this season. I need to catch up on it. But I saw this clip as it was spread everywhere because, well, let me just give some background here. This guy, I think his name is Joseph Torres, and he's basically given an option here. He's like the team leader, and the team selected him because they trusted him that he wouldn't eliminate the rest of the team. I think that's the situation, but I might be wrong. But when given the chance, he was offered $1 million to eliminate his team. So basically, if he breaks the trust of his team, he's immediately given $1 million. And those aren't game show dollars. That's real money. $1 million in cash deposited right in your bank account. That's $1 million to him if he eliminates his team. Now, let's go ahead and take a look at what he does.
Guys, come on! If you press that button, I will wire you $1 million!
JT, you slimy.
He didn't even take a break. Look at what he did here. In fact, look at the reaction of these different teams. He didn't even finish saying $1 million. He was halfway through the word, Jimmy was halfway through the word $1 million, and this guy hits the button. Like he hears the first syllable of $1 million, and he just hits the button right away.
I will wire you $1 million!
JT, you slimy.
And then the rest of the clip is his team, of course, being distraught, disappointed. One of the teammates here is trying to say how his character is ruined, how he's a slimy person for doing this.
Gave you some money if you was that desperate. You look real bad in front of God, in front of your comrade on this team. You look super bad.
She says you look bad in front of God. He took $1 million. Now God is judging him for eliminating this team, this group of people on this goofy game show, which is Beast Games. Now, keep in mind, this isn't like some type of business agreement. They're on a game show on Amazon Prime, and she's saying that he looks bad in front of God.
We don't respect you no more. I don't got nothing to say for you.
Now, there's other clips along with this where the rest of these contestants have tried to guilt trip this person for taking the money, saying that he basically did wrong by God. He's going to have to work on himself. That really, did he sell out for the $1 million? And it's just the most ridiculous take possible. Can anyone honestly look at this and say that they wouldn't take $1 million guaranteed to eliminate from a competition 5 people that they're never going to see again? People that they've known for 4 days? JT, this guy, doesn't know any of these people. Why does their opinion, why should he expect their opinion to really matter at all? This is a no-brainer. In fact, this is one of the easiest decisions that I think possibly could be made. If anyone's given, I think my case as well, if anybody's given the option to get $1 million guaranteed, and the consequence of that is they have to eliminate 5 people from a game show that they've known for a day or two, everybody should immediately take the $1 million without question, without hesitation, exactly like he did. Not only do I agree with his actions, I don't think he needs to apologize for anything. Apologize to God for what? Playing a game show and winning money? This wasn't some type of contract agreement with these people. It wasn't some type of business agreement. They're in an actual game show. It's the whole purpose of this show is to create drama, to eliminate people, and to try to get the prize. And he did exactly that. And in fact, even if you put it in the other perspective here, if I was one of the people on his team and I was one of the ones that got eliminated, I wouldn't even be angry. I wouldn't even be frustrated. I would fully expect him or whoever it is to operate for their own self-interest in a logical way. I could not even blame him as the one that would be eliminated as taking the money. So if I was one of the contestants, I would shrug my shoulders and go, okay, I mean, why would he not take it? Like, we don't have any big relationship. I haven't known this guy for 20 years. It's not like some type of blood-bound loyalty between us. Why would he not take it? While I thought it was interesting, and this contestant obviously did the right thing, I think there needs to be more interesting questions. Jimmy needs to work up more interesting moral dilemmas when he's offering people huge amounts of money. Because this one had no trade-off. There's only one right answer, obviously, and we want to see more interesting moral dilemmas. Really put pressure on people. Really make it difficult for them to accept enormous amounts of money. That's going to be it for this episode. Hope you enjoyed. See you in the next one.